My name's Tyler Tagwin. I'm a loan officer with Common Fund Mortgage in Syracuse, New York. When people come in to meet with me, one of the first places that I start with explanations of mortgages is to explain to them the two basic types of mortgages that are in the marketplace today: FHA loans and conventional loans. Main reason being is that there aren't many products available. These two are a good basis and place to start. What I'd like to do today is take some time and walk you through two side-by-side comparisons of what an FHA mortgage looks like and what a conventional mortgage looks like, so you can see the differences and gain a little understanding on the basis of mortgage loans. We'll take a look at it right now. When looking at the conventional versus FHA loan programs, there are a few things that differ the products from each other. We'll start with the conventional programs and look at the positives and negatives of that. Looking at two options here, both with purchase prices of $150,000, you'll notice that the loan amount on the conventional with 5% down is $142,500. Purchase price minus your down payment. Interest rates currently for a conventional mortgage are at 4.5%, so that's what we'll base our comparison off of. In this case, the monthly payment would be $1,262.33, with total cash to close of $16,249. Looking at the FHA loan program, we start again with a purchase price of $150,000. FHA requires a minimum down payment of 3.5%. After you take out that 3.5% off of your purchase price, FHA then requires you finance back in what is called upfront mortgage insurance, or an initial premium for your mortgage insurance policy to get the FHA loan. That gets added back on top of your base loan amount to get a mortgage amount of $147,283. Currently, FHA interest rates are at 3.875%, with a monthly payment, including your taxes and insurance, of $1322.09. In this case, our estimated cost to close are $13,394. Both of these cash to close include your down payment, your closing costs, and the estimated amounts we would collect for your taxes and for your insurance. Let's look at these in a little bit more depth. We'll first take a look at the cost of the upfront mortgage insurance. This is the amount that we just spoke about that gets financed back into your mortgage once you back out your down payment with the FHA loan. You will notice that on a conventional mortgage, it's not a requirement. I want to draw your attention to that because that's one of the negatives to an FHA versus a conventional mortgage. Again, conventional does not require the upfront mortgage insurance premium, whereas an FHA loan does. If we look at our payment breakdown, we'll start with the conventional mortgage. Again, the purchase price of $150,000 gives you a principal and interest payment of $722.03. We'll be using both the same taxes and insurance for both property or both loan types, both FHA and conventional. The mortgage insurance with a conventional is far less than it would be with an FHA. This is a benefit to going with a conventional mortgage. What this means is that your bottom line monthly payment will be much less than it would be with an FHA. You notice the principal and interest payment with a conventional is more. That's due in part mainly because of the higher interest rate. But your total monthly payment, once you take into account your monthly mortgage insurance, ends up being a lot less than it would with an FHA. So in the case of a borrower with better credit, a little more money to put down, conventional is typically the way that we would say that you should go. Again, looking at the FHA, you'd have a higher mortgage insurance premium and a higher monthly payment. Just a few things to consider. Now, the minimum investment required on a conventional mortgage is 5%, or your down payment amount. The minimum amount of out of your pocket for an FHA loan is 3.5%. Again, the same amount as the down payment. These are things to consider also while looking for different types of mortgage loans. So far, conventional requires more money down up front, has a higher principal and interest payment just due to the change in interest rate, the higher interest rate versus the FHA loan, but it has lower monthly mortgage insurance, which ultimately allows your payment to be lower. The FHA requires less money down, but has higher monthly mortgage insurance. FHA mortgages also require that you finance in upfront mortgage insurance into the mortgage, although you do have the option to pay it upfront as part of your closing costs. Typically, people do finance it into their overall loan amount. In a moment, we'll take a look at the closing costs so you can get a better handle as to what those will be. As we've just laid out a few of the differences for the conventional versus the FHA loan, we work our way through our closing costs, which are slightly lower with an FHA than with a conventional. And we work our way to the bottom line. Oftentimes, people see the bottom line figure, which includes your down payment, your closing costs, and your escrow figures for your taxes and your insurance, and they get a little bit concerned. What I'd like to do now is show you a comparison of the conventional mortgage and the FHA mortgage utilizing what are called seller's concessions, which is where the seller, through the negotiation of your purchase contract, agrees to pay a portion of your closing costs. Let's take a look at that right now. You'll notice on the line in the upper left corner that says cash to close has gone from just over $16,300 for the conventional mortgage to $11,974, and the FHA loan has gone down from around $13,000 to $4,700. Seller concessions are the tool that can be used to finance in some of your closing costs through the negotiation of the purchase contract. This is done as you make your purchase offer and you go back and forth with the seller to determine what the seller will take as their bottom line net for the sale of the house. It is important to ask your real estate agent or your attorney, whoever may be negotiating your contract, about the possibility of getting seller concessions included into your mortgage as part of the loan, as closing costs oftentimes tend to be one of the biggest concerns I find with borrowers, whether it be a first-time home buyer or somebody looking to buy their second or third home. So keep seller concessions in mind as you begin the negotiation process of the purchase of your new home. As a recap of what we discussed today, there are a few differences between conventional FHA mortgages. The decision really needs to rest with you. Make sure when you meet with your loan officer, you lay out your full situation, what your time horizon is for the house, what your goals are, what your intentions are for future purchases down the road. Some of these things may weigh into your decision as to whether or not you go with a conventional or an FHA mortgage. Remember that conventional requires slightly more money down than an FHA does. It's a requirement of 5% down versus 3.5% with an FHA. Conventional has slightly higher closing costs, and the seller can pay a smaller portion of your closing costs than would be with an FHA loan. Remember that FHA, although it has 3.5% down, does require you to finance in upfront mortgage insurance back into your mortgage. You can pay it out of your pocket, but either way, you have to pay that money, which you wouldn't have to with a conventional loan. The interest rates currently are lower with an FHA than they would be with a conventional mortgage, but your monthly mortgage insurance is going to be quite a bit higher than it would be if you went with a conventional mortgage. FHA closing costs are slightly less, and once again, the seller can pay a greater portion of your closing costs. All things to consider when meeting with your loan officer. Again, these are questions that need to get answered for you to make sure that you can make the right decision as to which loan option is right for you. We here at Common Fund hope that we're the choice for you. We look forward to speaking with you and working with you and having the chance to answer any questions you have about conventional, FHA mortgages, or any other loan possibilities that might be on the market today. Thank you very much for taking the time to listen to this, and we look forward to speaking with you and seeing you in our offices very soon.